Thanks so much, David. I appreciate you including me in the event today, and pleasure to virtually meet all of you this morning. For me, this midday, afternoon, wherever you're at. I'm based in the Seattle, Washington area, so I'm having a camera on here briefly, and then I'm going to turn it off to save internet bandwidth. We actually have wildfires happening in Western Washington, as if 2020 could get somehow magically worse. We've somehow managed to do it. Here in Washington, we've got fires raging in central Washington, and it's killing power and internet out by me, which is out in the Seattle area. So go figure how that works. But I'm going to cut off the video here in just a second, but I just wanted to assure you, yes, I am live here in Redmond, Washington. Happy to be with you. And, you know, when David said he was doing an event on investing and long-term trading, it was really exciting because for me, that's really where my passion is helping long-term investors understand different timeframes and really come up with systems and routines that empower them to make better decisions. And my work at StockCharts.com is focused on that with a lot of individual investors and financial advisors. And I also run a firm called Sierra Alpha Research, which is a research and coaching firm really primarily geared towards financial advisors to help them improve the decision-making portions of their investment process and build better relationships. So, you know, it's very timely. Obviously, in case you hadn't noticed, there's been a big rotation in the markets just in the last week. And this is after so much speculation about an overheated market to the upside. So about a month ago, I wrote an article called A Bull Market Top Checklist, and just sort of introduced, based on my experiences, here's what I'm looking for. Here's how I could see things playing out. And then my goal was to follow along with that if and when a bull market top happens, which at some point by design, it's probably going to, just sort of follow and check the boxes as things start to happen. What's great about the timeliness of this event is that we're just starting to check some of those boxes off. So what I'm going to do with the presentation here, if that's okay, is just share with you the checklist that I put together. I'll show you what it is. I'll talk through each of these items and explain where I see things headed from here. Before I do that, though, I do want to just introduce myself and my investment process, sort of my routine, my way of thinking, and hopefully that'll make the second half where we talk about the checklist a little more compelling. So as a reminder, please don't do anything with anything I'm about to tell you. That's kind of a standard disclaimer for any sort of presentation, but you've been warned. This next chart, just wanted to illustrate my background. So basically, I started in the industry in June of 2000, and I started at Bloomberg in New York City. And I came from a non-financial background. I actually studied music and psychology as an undergrad at Ohio State. And I was so sick of making sporadic money as a musician. I was a singer and a trumpet player, and it was great money, and then there would be no money. And it was hugely, painfully cyclical. And so I went for stability, and I went to New York and hooked up with Bloomberg, which was an awesome move. And I forgot to go back to music over the 20 years and basically spent 8 years of my life in New York City and across North and South America, really coaching institutional investors on how to incorporate technical analysis into their investment process. And for the first year or two, I was sort of getting started. But once I learned that there's a discipline called technical analysis that helped you understand what people were thinking and the emotional component to investing, which I had studied in psychology. I'd studied all about, emotions and biases and decision-making, but learning there was a whole discipline called technical analysis that allowed you to minimize its impact in your decisions and take advantage of the fact that other investors were poorly equipped to make good decisions. I was hooked, and that's where I started to focus my time. That led me in 2008 to be hired by Fidelity Investments up in Boston. I spent the next 8.5 years up there. I was running the technical research department in our asset management division. So we worked with all the equity portfolio managers and helped them understand the timing component of their equity portfolio. So it was, rating stocks, buy, sell, and hold based purely on technical disciplines. I was the president of the CMT Association from 2010 to 2014. So if any of you aren't familiar, I have the CMT designation. It stands for Chartered Market Technician, and it's basically a professional designation, kind of like a CFA or a CFP, but it's particular for technical analysis. Then in 2016, I actually left Fidelity. I launched my own firm in 2017 called Sierra Alpha Research. And again, my goal was to apply some of the tools that we use at Fidelity, but adapt them for financial advisors and individual investors. And that's been where I've been working for the last couple of years, until about a year ago when Chip Anderson, the founder of StockCharts.com, asked me to come out to Redmond, Washington, where I relocated, and now the chief market strategist at StockCharts. So I'm very, very happy working at StockCharts with a fantastic team. There's only about 30 of us in the office, well, remotely around the office at this point. But we do some really cool stuff for the toolkit at StockCharts.com, but also StockCharts TV, which is part of my role to manage that. And I still am able to run my my own business, which is pretty cool as well. When you think about my career history, we're going to come back to this chart a little later, and I'll talk about what it means for the current market environment. But, you know, I was concerned right around here with the cyclical nature of my job changes and cyclical bear market. So in 2000, that was pretty much at the top. And then in 2008, I go up to Fidelity, and pretty much just in time for a painful bear market going into the 2009 low. So I felt pretty good when I launched my own business, and we did not see a huge market downturn. But then, of course, I move out to Seattle, and soon after, we get a rollover. So the Dave Keller Premium Platinum Research Package, I will let you know when I'm considering another job change, because you can start to get defensive. And I'm totally joking. It's not a thing. But we're going to come back to this chart in a little bit and talk about the challenge of rotation from bull market phases to bear market phases. I wanted to just introduce sort of how I've developed, you know, sort of the process that I've kind of embraced over 20 years of doing technical analysis and working with investors. And hopefully then it makes the rest of the presentation make a little more sense. You know, I was taught when I learned technical analysis 2000, 2001, 2002, and I feel like I'm still learning every day. But when I was really in the heavy learning phase of my career, I was taught that the markets were driven by fear and greed. Fear on the downside, greed on the upside, meaning when people panic, when they're fearful, that's what pushes stock prices down. When they get greedy, euphoric, optimistic, that's what pushes prices higher. I think what we've seen, though, in the last 5 to 10 years is a rotation from fear versus greed to fear versus fear. I would argue that the markets are driven almost 100% by fear. And you might say, well, what about high frequency trading, quantitative, investing, funds, things like that? Or isn't that taking the human element out of it? And I would say what's happening is it's magnifying the human element. So the markets are driven by fear, and the challenge is quantitative models that follow trends and follow momentum, which almost all of them do, will magnify moves. And that's why sell-offs and rallies seem to be happening a lot more quickly. I think that's true. If you look at the first 3 months of the year, you saw a new highs, the S&P making a huge downswing and then turning and recovering super quickly. And that's not unprecedented that we have huge price swings. What is unprecedented is the time compression, how quickly all of that happened. And I would again argue that's because the markets are driven by fear. On the downside, it's fear of missing out. It's fear of losing everything. It's fear of downside loss, of downside risk. On the upside, it's FOMO. It's the fear of missing out, and that's palpable. And so people are panicked about missing this resilient bull market phase. And when the market sells off, people are anxious to get back in to ride it to the next high. But if and when things really start to get painful, they will accelerate much more quickly than it feels like you can react, because fear drives prices lower. So what do we do when the markets are completely driven by fear? Well, I think your goal as an investor is to be less mindless about that and be more mindful. And here's what I mean. I've applied lessons from 2 other disciplines, just besides technical analysis, into my process, which I'll share with you now. First is mindfulness, lessons from mindfulness meditation and things I acquired over the last probably 10, 12 years when I was really stressed out and dealing with that in very unhealthy ways. I came upon meditation, and it was a life changer for me, just a total change in perspective about how I would deal with thoughts and how I would, experience life and pay attention to what was going on around me. And the second thing is aviation, is flying, which we'll talk about in a moment. So when I think about mindlessness, I think many of us go through life in general in a mindless state, right? We're not embracing what's happening around us. We're consumed by anxiety and worry and the unknown and the uncertainty, especially now with so much uncertainty about the coronavirus, the elections, the economy. I mean, there's plenty going on. So what a mindless investor does is number one, they ignore their past. Bad, painful experiences, of which we seem to have a lot, you move past them. You mentally push them aside, you compartmentalize them, and you just focus somewhere else because it's tough to relive painful experiences as a human being. We are afraid of the future. We fear the future because it's unknown. And especially now where we don't know who's going to win the election in the US, we don't know how the economy may be impacted by another, an influx of coronavirus cases, the economy shutting down again. We don't know what's going to happen. We don't know really the odds of that happening, of vaccine and when it might come. And all of that has ripple effects on everything. And because we don't know what's going to happen, and no one does, we fear. That causes us anxiety. And unfortunately, because we're not learning the lessons of the past and we're afraid of the future, we worry about what's happening around us. We look around, we see the headlines, we see the negativity, we see the polarization of society, and we are consumed by worry. And as an investor, you see a day like today where the market's down another couple percent, Tesla's down 10+%, and you think it's the end of the world, and that causes anxiety. What a mindful investor does is have a much better way of dealing with the past, present, and future. And what I would encourage you to do is think about on that last slide how much I just described of you and your way of thinking, and how we can start to rotate to more of a mindful way of dealing with the investment landscape. So instead of ignoring the past, we learn from the past. We have a regular process of reviewing our wins and reviewing our struggles, right? Going through our trading journal and identifying when we really got things done well, what caused us to make the right call at the right time, but much more importantly, where do we miss something? What happened? What went poorly? And what can we do to try to improve that for next time? We don't have to worry about the future because we have a game plan. We have a plan laid out. And I would argue a day like today is not the day to start coming up with your exit strategy on a long position if you were long at the beginning of last week, right? When the market's making new all-time highs, that's when you want to start thinking about downside risk. That's when you want to be checking all of your stops and making sure that they're in the right spots. This is when you think about, if XYZ would play out, what am I going to do? And then you don't have to worry about what's going to happen because it's a decision tree. If X happens, I do this. If Y happens, I do that. If Z happens, I do that. And then you just have to execute on what you've already thought through ahead of time. Finally, because we're learning from our past and we have a plan for the future, we don't have to be anxious or nervous or uncertain about the present. We can actually live for the present. We can focus on what's going on around us. We can focus on developing a good market awareness, or what I call a situational awareness, which is having a good broad perspective of what's happening so that you're able to continue this process of learning from your past and preparing for your future. So again, I'd encourage you to think in your own, where could you upgrade your own routines, your own process for each of these timeframes? Because I bet there's maybe one or two that you probably could be doing a little bit better. So what I just shared with you is some of the lessons from mindfulness. The other big area that I tend to draw from is aviation. And I'm a student pilot. I've got about 80 hours in a Cessna 172R, which is a pretty classic training airplane. And this was a moment of not taking myself seriously, which I would encourage you all to do at some point. But bear in mind, it was in safe airspace. I knew exactly what was going on as I was doing random selfies in the cockpit. This was on my first long solo, and I was so excited when I made the last landing, was able to fly back to my home airport. I shot this one. But when I was first learning to fly a Cessna, I talked with my flight instructor a lot about the markets, because he actually would trade stocks based on charts when he wasn't flying. And so we would often, during quiet moments in the cockpit, would sort of debate trading and time. And what was funny is we very quickly identified the interrelationship, the similarities between a pilot trying to make good decisions in the face of uncertainty and things that could and often do cause emotional reactions, and investing, where you're trying to do the same thing. You're trying to not overreact by the fact that you're losing money or that something good or bad happened. You're trying to just put your poker face on and make good decisions. And again, you're trying to do the same thing in both places. So a couple thoughts about how these are related and why they're important. The presentation here is going to get into a bull market top checklist. And the reason why checklists are so important to me is because when you learn to fly, it's all about checklists. You don't get in the airplane until you've checked about 100 different things and made sure that every system, every flap, the rudder, every tool, every system is operating as it should, and you minimize the chance that the plane is going to get messed up, right? And so this is actually the pre-flight checklist on a Cessna 172R just before you, engage the propeller. Is you flick on the master switch, the emergency beacon, you open the throttle, the mixture and the fuel pump. The mixture is the fuel to air mixture. The fuel pump you turn up, make sure it's off, and then you yell out the window and you fire up the propeller. And I had about a 99.9% success rate in getting the propeller to start because I'd checked everything very consistently using a paper checklist. And it's so funny as investors how we don't do that. Once we sort of get comfortable, we get dangerous with our use of charts or technical analysis. We start to lighten up on the reins, and we can often get a little sloppy in terms of our analysis. And I think, there are very good things about social media. I see a lot of people trying to analyze and learn from each other, which is really cool. I think that's awesome. But I also find that there's a lot of amateur technical analysis, and that concerns me a little bit because I think it encourages bad habits and lack of discipline. When, to be honest with you, I think good trading and good investing is based on working hard, developing a good, consistent process and applying it consistently. And randomly throwing charts around is usually not the way to do that. So this is a checklist that I've developed over my career, and it's literally these 7 steps that I still use. Now, I used to write these down, and when I've taught technical analysis at the college level, I've made students go through and literally write the answer to each of these questions, and then you have earned the right to say you're bullish or bearish, or say buy or sell on a particular stock at a particular moment. This doesn't have to be your checklist. You may have your own, and that's great. My thought to you, though, is that you should have a checklist. You should have a list of things that you agree to review before you make a decision on a particular chart or on a particular asset. This is the kind of thing you should write down and tape it to your monitor, and don't get away from that, right? The more you apply this consistently, the more you internalize it, and the more I would argue, the better the chances of you having more consistent good returns is based on your consistent use of a checklist. Another big component of flying is called situational awareness. And there's a reason why my firm is called Sierra Alpha Research. That's slang for situational awareness. And it's basically what pilots are taught. And it's essentially to understand, be aware of what's happening inside and outside your cockpit at all times. And a quick story on this: one of my first flights, I'm up in the air. It's a night flight, which means you're trying to get used to flying in the evening, which is a little disorienting because if the stars are out, there are lights in the air, there are lights on the ground. It's hard to see the horizon. And I was learning to fly around Boston, which is pretty densely populated. So it would get kind of disorienting very quickly. You can fly into clouds and not realize it, and that can be dangerous. And so you're taught to pay attention to what's going on. Well, I had my map out in front of me, my little VFR sectional. It's a map of your surroundings. And I'm trying to just plot out where we're headed and make sure the timing's right. And my flight instructor in the right seat says, all right, if you look around 10, 11 o'clock, do you see anything that's important? And that means, sort of left of center out of the dashboard. So I look out and I look around. I'm like, no, I don't think so. And I go back to the map and I start going, he's like, are you sure about 10:15, 10:30 is not something really important? So now my palms start sweating, and I'm just like, oh no, this is clearly a signal that something's going on. And I look over, sure enough, I see headlights on another aircraft, and it appears to be coming right at us. So I said, yeah, looks like traffic here at 10:30. They said, yeah, it looks like we're dangerously close to a collision course. One of us needs to divert. So we tried to get him on the radio, couldn't get through. So the instructor pushed the yoke forward, which put us down about 500 feet very quickly. We flew underneath the other airplane, came back to our original altitude. The other airplane never really changed course. Now, the chances of us literally coming into contact with another airplane, it's actually really hard to do because there's a lot of space up there, but we would have been way too close for safety. And that's what was important. And it was such a good lesson for me to remember that I can't get so caught up into my plan, into a thought process, that I'm not having an awareness of what's going on around me. And I think a lot of times as investors, we get our blinders on. We sort of focus on a particular trade or a particular company, a particular theme, a particular market call, and then we lose connection with the evidence that we're seeing around us. I think one of the great benefits of technical analysis, of charting, is that it allows you to understand what's happening and to see, to visually identify what's working and what isn't. And you will be able to anticipate things because you will see the signals on the groups and the themes and the charts that are starting to work or starting to not work. So I took a lot out of that concept of situational awareness. And when I've worked with clients, we've talked a lot about just what your dashboard is, what your routines are to make sure that you understand what's happening. And then finally, the last thing I think I bring from, or maybe one more thing on aviation was the process of emergency preparedness. This was on one of those flights. I'm looking off the right wingtip, and this is Providence, Rhode Island. Might be a little hard to see. This is Providence Harbor, and way off in the distance is Cape Cod, kind of going to the left. And so I was enjoying the view of Providence, which looked very pretty from here. But while I was enjoying the view, I also knew that off my left wingtip, couple miles away, was North Central Airport, which is this little X-shaped pattern on the ground here. So I knew based on my altitude, based on my distance, if I lost the engine right at that moment, I knew that I could deviate course over there. I had the frequency jotted down on my knee pad, so I knew how to, switch over into emergency mode and get the plane on the ground safe. And I knew I had plenty of space to do it. So even though I'm sort of enjoying myself and taking things in, I always have a backup plan in mind. And again, as investors, when things are going great, when your plane is flying straight and level and there are no issues, that's when you think of your exit strategy. As investors, that's the same thing. I always coach people, when you take a position, that is the time to set your exit strategy. It's not later when things start to not work. That is not the time. When the engine cuts out and you start going down, that is not the time to look out and figure out if you can see an airport around you. It's well before that. And I think that was one of the planning lessons I learned from flying. And with both of those things, with meditating and with flying, I think the way that I improved, and I still can continue to improve in both of those disciplines, is by building good routines. You don't learn to meditate by doing it a couple times and then not doing it again. You learn by doing it every day consistently. You learn to fly by getting up in the air consistently. You learn to golf or to play an instrument or to whatever by doing it consistently, right? And perfecting it over time by practicing it. I think as investors, it's very easy, especially with charts, to sort of cherry pick particular charts. All right, I'm going to look at Tesla right now and just look at the chart and determine what I think. And again, given, if that's all you have available, if someone suggests some new stock, I think bringing up a chart is a great way to understand the conditions and make a good decision. But you're really going to grow as an investor by having a consistent routine that you follow religiously. So I have a set of things I do every morning. I call it a morning coffee routine. I have a weekly meeting, a weekly review of all the charts. I go through the S&P 500 charts every weekend, one by one. And that's a process that I started years ago, and I've continued to do it regularly. And as a result, you will see the evolution of Tesla from a bull market trend to a bear market trend. You will see when bank stocks like Capital One have been underperforming and then they just start to turn up on a relative basis. And you'll notice it because you've gone through them consistently. Now, if you have a good routine in place for reviewing charts, that's awesome. And I would just encourage you, have a period where you regularly go back and just review, do you need to tweak anything in that routine? Keep upgrading it if you can. If you don't, you're welcome to use mine as a starting point. If you're a Stock Charts member and you go to StockCharts.com, click on your dashboard, you'll see a little section called Manage Chart Packs. If you look at all your chart lists, and you'll see one called, or a set of them called, a chart pack called David Keller's Morning Coffee Routine or something kind of like that. And what that will do is install this list of charts, which is, these are my Google Chrome bookmarks that you're seeing here. But this is basically the routine that I go through every morning just to review where things are at and make sure that I follow it. You are welcome to borrow my routine. I would encourage you to make it your own over time. Take out what doesn't make sense, add what does. And over time, I think you will find by following something like that consistently, you will be better equipped to understand what's happening around you as an investor. So that's a bit of my investment philosophy, how I think of things. And this brings us back to that chart of my my career history. So, if you think about when I started to learn technical analysis, I learned technical analysis at the beginning. I first learned it here in 2000 to 2002. And so I learned technical analysis as the market was rotating from the biggest secular bull market in US history to one of the more painful bear markets, because this was the unwinding of the tech bubble and 9/11 in New York, and a lot of really challenging experiences for sure. But I learned technical analysis, and it was cemented in my mind from the beginning of its value in risk management. For me, technical analysis has never been about hitting the next home run. It's making sure that you're managing the potential for downside and locking in profits. And that's why trend following and identifying trend exhaustion has been core to what I try to do. That was reinforced when I went up to Fidelity in 2008, and again was taught painful lessons about making sure that you're, not on the wrong side of things, especially during a deep market correction. Having some things, some lines in the sand written down, and a lot of the checklists that I've talked about came from those periods, and seeing what helped me identify, or what could have helped me identify, market downturn. And that's been good. Where it's been tough, and I think one of the worst calls I ever made as an investor was getting bearish in 2013, because I saw us going back to previous highs. I saw a lot of similar things with divergences and everything. And I felt like a rock star in 2007 when I suggested that the market was going to exhaust, and it did. I felt like less of a rock star in 2013. But it was also a fantastic lesson of recognizing when your call is incorrect and adapting, right? I think the best investors for me are not the ones that stick to, have a game plan and stick to it, whether or not it's working. They're the ones that learn to adapt and recognize when things are changing. So it took me a little bit of time, but when I finally said, you know what, the trend is so positive, I think that really solidified how I approach things as a trend follower. I tried to stop thinking just about market tops and anticipating them. I tried to anticipate them, but focus primarily on price. And so when I wrote this article a little bit ago on August 19th called The Bull Market Top Checklist, What Would Change My Mind? That article was driven based on how I think about the macro landscape. And I think of it in three parts. Number one is price. Number two is breadth. And number three is sentiment. And those are in priority order. So number one is price. Until the price starts to break down, until the price stops going up and starts going lower, the trend is positive by definition. That goes back to Charles Dow, the grandfather of technical analysis, whatever you would want to call him. Basically pioneered the of trend following and analyzing charts for trends. His thought was essentially the Dow theory method of looking at price trends and measuring them by looking at highs and lows and whether they were going up or going down. So I think until we start seeing lower highs and lower lows, the trend is up. And so the price is number one. The way we anticipate what might happen with price is using breadth. And that's looking at things like advanced decline lines, the McClellan oscillator, any of those percent of stocks above a moving average, any sort of indication that give you a heads up as to when the conditions are starting to change. And what usually happens is the breadth will lead the price. So breadth will turn negative, then the price will turn negative. At a bottom, breadth will start to improve, then the price will start to appreciate. And we'll look at what that means for the current market environment here in a moment. And then third in priority is sentiment. And for me, it's things like survey data, the AAII survey, right? The individual investors. It's things like the VIX, looking at volatility. It's the put-call ratio, looking at options investors and where they're positioning. And so, I would never make a trade 100% based purely on the VIX. But what the VIX does tell me is it informs what I'm seeing with breadth and with price. So for me, it's in that order. And again, you can have your own process. That's totally fine. But I would have a really clear laid out plan of what your order of importance is and what information you are going to look at right now to determine whether or not the bull market that we've seen up through last week is going to continue, or whether this is the beginning of something more deep. So what I'm going to show you here is just I'm going to switch actually to some live charts here. I'm going to show you the article that I wrote, and we're going to just go through each of the 5 bullet points, and I'll show you the current chart, how it's changed since mid-August, and I think what it means from here. So first off, and again, as a trend follower, the first thing I'd be looking for is a failure at resistance, and what that means, or a failure at resistance with bearish divergences. And I think the divergences are a pretty key part of that. If you look back at the February market peak, and here we're looking at a chart that's updated through, sort of mid-August. This is right as the S&P was testing previous highs. If you look at the peak in January to February, you had this situation where the price went to higher highs. So it made a new high in January, another new high in February. But if you look at the momentum, if you look at the RSI, the Relative Strength Index, this is a measure of price momentum as the price is evolving over time. You see lower peaks in the RSI, and that's called a bearish divergence, where you see higher highs in price, lower peaks in the RSI. And what that suggests is a lessening of upside momentum. As the price is moving to new highs, there is less upside push, there is less buying power, there is less demand, however you'd want to describe it. There's less upside momentum propelling the market to further highs. When we look at breadth, we'll understand maybe a little bit more of how that can actually happen. But it is pretty characteristic. If you look back at major bull market tops, you will often see this sort of bearish divergence. And I think the most obvious one is if you look at 2007 to 2008, you had a lot of similar periods where stocks were going higher, breadth or momentum, was rotating lower. Now, at the time I wrote this, I was seeing, all right, the S&P is testing previous highs just below 3,400. Seems like an ideal time for the market to make a double top. We're also seeing a potential bearish divergence with lower peaks in the RSI. Let's look at the current chart and see how that's actually evolved. So this is looking a little bit further now. We've zoomed in a little bit. This is the January, February peak here, sort of halfway through the chart. Here's where we're at now. So if you look, we obviously continued above 3,400, and I think that break above 3,400 was key. What was also interesting is the fact that that bearish divergence that we saw before, which was right here, was invalidated, right? So a true bearish divergence really isn't in play until it breaks lower, until it confirms it by the fact that the momentum starts to dissipate. It never really did. It's just sort of continued higher and higher. So I think what looked like a bearish divergence really didn't end up being one as the momentum went even higher. And this is as we accelerated up into the peak last week. What happened there is the S&P's RSI went above 80, and that's what I'd call extremely overbought. And that means when an RSI is above 70, that means we've gone too high too quick. It usually means you get a bit of a downside pullback because we're overextended. We sort of right the ship, and then we are able, open up the way to continue to potential further highs. But what happened here is we went extremely overbought. And what that usually means is you'll have a pullback out of that overbought condition, usually have at least one more push higher. And what happens there, that's where you start to get lower momentum on the next push higher. That's when there is such extreme optimism. There's enough to push the price one more move up. And whether you make a new price high or you fail there, usually the momentum almost always is a little bit lower. And that tells you that's sort of the confirmation of the top. Right now, I think we've gotten the light version, the suggestion that this was a blow-off rally into the peak. We are now right at support, which is that 3,350 to 3,400 level. That's the support level we saw in early to mid-August. If we hold this and hold the 50-day moving average, that ends up being, opening the way for the next move higher. And you look to see where the momentum peaks out. And that's driven by the fact that people believe that the market's going to go up forever. And there's a huge FOMO with anyone that missed out on this run. And if you have an opportunity to get in here, that'll usually push the price for one more move higher. You saw that in February when you sold off into the last week in February, the first week in March. You bounced off pretty good, actually, from around 28.50 all the way up to 31.50 in a couple days. So that's that sort of move I could argue that we might be looking for next. And then the question is, are we able to reclaim the highs and continue the uptrend, or do we break that swing low? Do we break that 33.50 level again and push the price to new lows? So this was number one, which is basically a failure at resistance. We didn't see the failure at resistance, and we've not gotten the bearish divergence yet. So based on my very simple checklist, this is not qualified yet. This is not a checkbox just yet. Question number two, or item number two on the checklist, is a breakdown of support. Once you sort of get some rotation lower, are you finding support at key levels? And that's what I just alluded to here. What I always talk about, and there's a reason why my show on Stock Charts TV is called The Final Bar. I spend a lot of my time talking about the final bar. What's the current price bar? And then you look to the left and see where we're at relative to where we've been. We polled many of our viewers over the last couple days about what they used as their primary stop loss mechanism. Over 50% said support and resistance levels, price support and price resistance, as opposed to trailing stops, average to range, some more, exotic, they're not very exotic, but, a little more complicated forms of risk management of stop losses. Most people said simple support and resistance levels, which I think is totally valid if you do it consistently and if you do it well. So for me, looking at a chart of the S&P, as we keep making higher highs and higher lows, Charles Dow taught us over 100 years ago, that means the market's going higher. So you can debate here in mid-August whether or not the market should be going higher. You can debate whether, where it might find a top. But at the end of the day, as long as the price keeps making higher highs and higher lows, the trend is up, and the trend is up by definition. And that's not an opinion, that's the factual information based on the trend. So what's happened now is we made a higher high going into last week. That's true. And now the question is, do we make a higher low, or do we hold the most previous pullback low, which if you look at the price is right around 33.50. And that's the low that we saw here. As the market was testing 3,400, we sort of sat here around 33.50 before we broke to new highs and continued on almost to 3,600. So the question for me is, are we able to hold this level, 33.50? If we are, then again, the uptrend by definition is still in play. The market is by definition in an uptrend until proven otherwise, until we get a lower high and a lower low. If we break down through there, if we follow through and break down through the 50-day moving average, the next level for me would be 3,200, which is this range down here. This is, when the market hit a peak in June, that was quite a rotation. This is when a lot of other industries like industrials, materials started to emerge as financials started to emerge as potential new leadership. Technology sort of took a bit of a breather, and it was, is this the rotation that's going to take us to new highs? It didn't, right? And at the end, what pushed us to new highs was going back to the mega cap technology, communication services, consumer discretionary trade. It didn't really follow through. So this pullback, when we found support around 3,200, I think was really key. This is when we tried to break out to the June high. We sort of sat here for about 2 weeks before we moved on. So I think that's a really important level. If we are unable to hold that, I think by any stretch, that by definition on that time frame, on that tactical time frame, the trend is now down. And I think if you haven't figured out an exit strategy for long positions by then, I would certainly be, and again, I would encourage you to be doing it well before today. When the market's going higher, that's when you want to think about where you would take profits or where you would stop losses, where you would manage your risk. But if we would break down through S&P 3,200, I think as long as we remain above that, I think from a pure long-term technical perspective, you can consider us still in an uptrend. If we break that, I think that that tells you that we have potential for much further downside. And there's no reason why the market can't go a lot lower than we've been. And again, I don't want to go through market headwinds and tailwinds in terms of the Fed and the coronavirus and the election. There's a lot going on, but I want to focus on the charts just for the sake of this conversation. But that's where I would be looking at is 3,200. So point number 2 is, are we breaking down through support? As I mentioned, I think 3,200 to 3,250, that's the level. As long as we remain above that, I would not check that off. If we break down through 3,200, I would check that box and say the top is in and we're now rotating lower. The third one is validation of a downtrend. And I have a market trend model that I created years ago and evolved it over time. I'm always trying to tweak things and improve them. And this is sort of what the model looks like. I'll talk you through what it is and what it's telling us. So this is using weekly data on the S&P 500. I'm using the spiders here. And it has 3 pieces: long-term, medium-term, and short-term. And again, those are sort of general placeholders for general periods of time, but it doesn't really have a particular period of time because it's based on the trends. Trends can happen quickly or less quickly depending on the dynamics of the market. But here's kind of how I think of things. Using the weekly data, we're starting out with the 21 and 34 week exponential moving averages. That's the blue and the red lines up here in the top panel. This long-term indicator, which has been bullish since early June, is basically looking at the difference between those 2 moving averages. If they cross up through one another, that's a bullish signal. If they cross down the short-term through the long-term, that's a bearish signal. And in general, it's been bullish for most of the last 5 years. It turned negative here in December of 2018 as the market sold off, turned back positive in February, turned negative here in mid-March, again, after a significant sell-off, totally fair, and then turned back positive in June. And this is not designed to pick out tactical turns. It's really more as a general risk measure and eliminating the possibility of a huge climactic loss that would ruin you as an investor and eliminate a lot from your account. And so again, at this point, it turned positive in June. It's remained positive. Then I use the regular weekly PPO, and this is using the traditional settings. PPO is very similar to MACD. It's just based on prices, percents, instead of price values. MACD is based on moving averages driven by the price values. PPO is driven by the moving averages, but using percentage terms. And as a result, it's a much better historical look at a lot of things and allows you to compare things a little more easily, is what I found. So the weekly MACD or the weekly PPO, and it's using the traditional settings and the traditional signals. This turned negative in mid-February on that first big sell-off. It turned positive here in mid-May after the market had rallied back pretty well off of the bottoms and has remained positive. A sell signal there would tell you that medium-term time frame has turned negative. That leaves us with the short-term time frame. And to be honest with you, if I'm thinking, quote unquote short-term, I'm looking at a daily chart primarily, but on the weekly chart, I like to have a short-term gauge just to see how all those time frames are lining up. And what I do is very simply, where is the price relative to the 5-week exponential moving average? If it's above it, we're short-term bullish. If we're below it, we're short-term bearish. I update these every Friday. So as of Friday, it remained positive. Based on where we're at today, it would turn negative at the end of the week if we continue to to sell off or remain around these levels right here. So that's sort of that time frame. And so my thought with this bullet point on the checklist is usually what would happen is the short-term signal would occur first. That potentially is happening this week. The medium-term signal would be the confirmation that things are happening. So if you look at this checklist, starting with a failure at resistance or bearish divergences in place, a breakdown of support, then a validation of a downtrend, that's essentially a sequential pattern. You would most likely get a bearish divergence confirming a topping, conditions for a top. You would then get a breakdowns of support, short-term support, identifying that the price has started to go lower. Then you get the validation of a downtrend by some of these long-term trend following models turning bearish. And again, that's the 3 steps I would look for. All 3 of these have not turned negative yet. So even though we've had a little bit of short-term pain, I think it's worth recognizing that within the long-term framework, we're still by default in an uptrend. I can see, and I've laid out some of the things I would look for to confirm that we're in a downtrend. And I think when we get to breadth, you'll see why I'm fairly confident we are going to get those sell signals in the near future. But again, the chart is the chart, and I will follow the price. So these next 2 are independent of the first 3. The first 3 are essentially 1, 2, 3, probably in order. These next 2 will happen at some point, and breadth is often a leading indicator, which is why I'll talk about it here. One of the charts I look at is using the cumulative advanced decline lines, and I'll show it's this one. This is basically the cumulative advanced decline line. This is the S&P 500 at the top, and then this is the common stock only advanced decline line. This is the S&P 500, so large caps. This is the mid cap index. This is the small cap index, and large, medium, small at the bottom. That's what it's doing. I have very subjectively color coded these green, amber, or red based on where I see the trend in these indicators. So the advanced decline line in the S&P 500 made a new high last week. So by my read, higher highs, higher lows, it's in an uptrend, it's confirming bullish. The rest of these have not confirmed a higher high. The broad New York Stock Exchange, using only the common stocks, mid cap index, small cap index, have all not confirmed the high from last week. So what that tells you is, and again, advanced decliners are basically a measure of breadth. So it's telling you every day how many stocks are closing higher or lower, and it's a cumulative measure because you're stringing together those daily changes over a longer period of time. And overall, in a healthy uptrend, the cumulative advanced decline lines will be making new highs. When an uptrend starts to not be healthy, and we look here at the January to February period, you can see that even though the S&P advanced decline line was making new highs, the mid-cap index sort of did not. The small cap index and the common stock only index advanced decline lines all confirmed a lower high. So while the S&P was making new highs, while the cumulative advanced decline line, the S&P was making new highs, everything else was telling you that the breadth was weakening, meaning small and mid-cap stocks were already starting to roll over and sell off. We're potentially seeing that same pattern right now, where the S&P breadth has remained positive. All the others have not confirmed the rally. So these lines making new swing lows, breaking low below the low from mid-August, that would turn them red in my mind, and that would confirm negative breadth. Right now, we're seeing the potential for lack of confirmation. That would be a downside follow through, and that's why it's bullet point number 4 for me, is seeing whether we see that breadth deterioration. I'll rotate just another moment and tell you the one other thing that I didn't put as one of my bullet points, but I think another key chart to watch right now is this one. This is looking at the percent of stocks above the 200-day and above the 50-day moving average. This is looking at the last 10 years, so it's quite a bit of history. And so in blue, this is the percent of the S&P 500 names that are above their 200-day moving averages. In green, it's the percent of S&P names above their 50-day moving averages. As of Friday, this isn't updated for today yet, but as of Friday's close, 72% of the S&P was above its 50-day moving average. And if you think about it, that means 3 out of 4 stocks, even though a lot of stocks sold off on Thursday and Friday, 3/4 of them remain above their 50-day moving average, just like the S&P 500 has. So even though they've sold off, they were so extended from their 50-day moving average, most likely they haven't broken through that key first line of defense, that key support level, right? So even though we've pulled back, we're still well above where we were a couple of weeks ago. And I think that's worth remembering. However, what I would be looking for is the challenge that we have right now is as the S&P is pushed to new highs, this indicator peaked actually in June when the S&P made that June high. As it's gone to new price highs, as the S&P's reached 3,600, you can see less and less stocks are regaining their 50-day moving average. So that confirms that it was a relatively small group of stocks that have sort of reclaimed those highs and continued higher. So a breakdown in that breadth indicator would be a key tell for me. And then the really good long-term tell is this one, which is the percent of stocks above the 200-day. As long as this remains above 50%, even in a bit of a painful pullback like you saw in mid-2019 here in sort of May to June, and again a couple times going into the fall, every time it was a pullback within a longer-term uptrend, and the indicator here never really got below 50%. Same thing happened in 2018 and 2016. It's been pretty consistent, even back here in 2012, 2013. The times when it has gone below 50% in general have been pretty painful, like the 2015 to 16 corrective period. The end of 2018, you can see it broke below 50% here in October before the real pain started. And it turned negative here in the first quarter of 2020 as well. So if and when it would break down through that 50% level, that would be an area of concern for me in terms of validating. That would come pretty late, and we'd have to sell off pretty good to trigger that sort of thing. And then finally, the fifth item, now that we've hit on price and then looked at breadth, and now it's more of a sector rotation play. You know, what improvement do we see in the defensive parts of the market? There are a number of ways I look at sector returns. Here we're looking at the 11 S&P sectors. This is called the candle glance function on stock charts. Just gives you these little preview charts, and areas I would look at would be real estate, utilities, areas like that, staples. You'd want to see things like consumer staples outperforming consumer discretionary. That has not happened yet. You'd want to see things like utilities outperforming the S&P 500. That's not happening yet. So the traditional areas of defense showing you that big institutions are getting out of the stuff that got us here and getting into the things that are more income generating, are more defensive, and are designed to help you weather out market downturns. That's when it tells you that things have the potential to get a lot worse. The confounding factor right now is the fact that technology has served as offense and defense. And I think that's one of the more interesting themes that we've seen. Since the market low in 2018, technology, this is the XLK relative to the S&P 500, technology has been outperforming. So even during the market downturn in 2020, even through the corrective periods in mid-2019, even through the sector rotation that we've had later in this current year, overall the trend in the relative strength has been up and to the right, meaning it's been good offense and good defense until proven otherwise, until this relative strength starts to break down, and hasn't even broken down the most clean trend line just from the June pullback to the July pullback. We're still above that trend line. Until we start breaking down through some of those trends and signaling that the relative strength is rolled over, it tells you that even though the big cap tech names got us here, they're still being treated as defense overall. And until that relative strength pattern turns, I think you have to think of something like this as more of a core position. It's more of a general assumption that technology is going to continue to be in the driver's seat. But again, what I would be looking for to sort of validate this fifth bullet point is to see people rotating into the traditional defense, and particularly utilities tends to be a good place to watch for that. So that was my my bull market top checklist, and again, it had 5 components, and it was driven on this methodology that I explained to you earlier. It starts with price, number 1, and again, for me, I will remain in assuming the trend will continue until proven otherwise. And even though the last week and today we're following through with some pain, and on particular charts, particular stocks, arguably we've already broken through support. And I think at that point you need to recognize that that picture's changed. But when I think about the broad market environment, I'm seeing conditions that could still be a constructive pullback within a long-term uptrend. And again, I have an assumption based on breadth and based on the divergences that I'm starting to see, and based on the weakening characteristics of the advanced decline lines, which I showed you. I'm assuming that if you asked me to bet, I would tell you that I think we're going to go to 3,200. I think that's going to be the next point where we have to determine whether or not this is a much deeper downturn or not. But overall, I'm going to wait for the market to tell me until we break down through price support, until the trend turns over, the trend is still positive. I think that's worth remembering as an investor. The only other thing I would stress thinking about this bull market top checklist, and again, these are the things that I've identified as things that are important to me. You're welcome to take these 5 and have that be the checklist that you watch. But I bet using your methodology, depending on what charts you look at, depending on your time frame, you may have different items in mind. My point of this is not to tell you what is going to happen, even though I have a general sense of where I see things going. I think you've probably gotten that feel based on what I've shown you. I would encourage you to develop your own checklist. And I think that's what hopefully my main takeaway is here. I find the best investors, they understand how they think, they understand their strengths and their weaknesses, and they use checklists like I just laid out as a way of freeing themselves from the burden of emotional reactions to what's actually happening. I don't have to worry about the fact that stocks are coming off a bit today because I've already laid ahead of time. Things are fine in my portfolio or in my methodology until XYZ happens. And these are the things I'm going to look for. And when they happen, I'm going to check the list. And when this happens, I'm going to exit a long position or do whatever action I need to take. The point is not the particulars in the checklist necessarily, even though I feel pretty good about what's in mine. My goal is to encourage you to develop your own and think about what should be in your checklist. And very importantly, even, you don't need to write a blog post about it. Write it down, write it in a journal, write it on a piece of paper, tape it to the wall, tape it to your monitor, and review them regularly and see how the conditions are evolving based on what you are assuming. Now, I hope this was of interest to you, and I hope I challenge you to think a little bit about your own routines, your own decision making, and how you can handle a market regime like we're seeing right now and in a transition phase by laying things out ahead of time. If this is something you want to work more on, 2 things I would point you to. Number one, if you go to my website, which is called marketmisbehavior.com, I have a free behavioral investing course. I'd encourage you to take it. It's a 5-week course over email and basically challenges you in a little more detail, a little more maybe painfully to address some of the potential weaknesses in your own decision making, using some of that methodology we talked about with the mindful investor and the mindless investor. What we'll try to do over 5 weeks is get you further from the mindless investor slide and into more of the mindful investor slide, and thinking about your routines, thinking about how you're making decisions, and challenging you to do some homework along the way to improve it. And the feedback I've gotten from people that have gone through that has been pretty helpful. It doesn't give you all the answers, but it certainly helps you to start asking the right questions to start a journey of improvement over time. So marketmisbehavior.com, check it out if you're interested. Then the last thing, as I mentioned, as chief market strategist at stockcharts.com, one of my favorite parts of my role is managing Stock Charts TV. It's a fantastic place to understand the markets and to follow market analysis from a technical perspective. Our goal is to educate you on what the charts are saying using the Stock Charts platform, obviously, but we have a ton of fantastic guests coming through our shows, doing special events on the channel. Guys like Larry Williams, Martin Pring, John Murphy, Tony Dwyer, all sorts of guys, Arthur Hill, Greg Schnell. I could ramble on. A lot of really, really cool guests and hosts. My show is called The Final Bar, and I host our Closing Bell show. It's running at 6 p.m. Eastern, mainly because, as in Washington, as in much of the U.S., we're unable to get into our office consistently. We have this beautiful studio in Redmond that we can't use for social distancing purposes, so we're doing things a bit on a delay so that we can get them out appropriately. But every weekday, 6 p.m., we'll run my show on our website. Then we'll post it to our YouTube channel afterwards. Just look for the Stock Charts YouTube channel. And if you can read the tickers on the final slide, you'll get my final message, which is thank you. David, this is a pleasure to be a part of these events. I appreciate what you're doing to help all the participants try to improve what they're doing. And again, I've learned so much over my career, 20 years and hopefully 20 more, if not a little more. I've learned a ton from others that have come before me and have been willing to share their expertise through the CMT Association and through other market events and organizations. And I'd encourage you to get involved and get to know others, especially through social media. I think it levels the playing field in such a positive way to help you learn from what others are seeing and what they're hearing, and again, hopefully become a better investor over time. I'm going to take a moment. If you have any questions, please put them in the chat room. I'll take a look and see what I can answer here. All right, so I'll answer some of the questions that I've seen on here. First, what is breadth? Right. So yeah, sorry. In the limited time, I glossed through, and if you caught it, I kind of went back and explained it a little bit more because I didn't mean to breeze through what I consider to be a very important topic. Let's look at this chart, and I'll explain to you what breadth is. So, um, you know, exercise number one, if you want to understand what a market is doing, is look at the index, right? Look at the price. And as I told you, my methodology starts with price as the number one most important thing. Your main goal as an investor is to understand the trends and to understand when the trends have changed. And I believe that's the truth. And whatever your time frame is, and depending on what your methodology is, it all comes back to identifying trends and identifying when trends are changing, identifying inflection points or exhaustion points or whatever you want to call them. But number one is trend. And the first thing you should be doing is identifying what the trend is. So when I'm looking at the S&P 500, I'm looking at the closing prices here, although usually I'm looking at a bar chart. I do this just to simplify the comparisons that we're able to do. But usually I look at a bar chart of the S&P 500 like I'm showing you here, and I'm looking at the highs and the lows, and I'm looking at the moving averages, and I'm making an assessment of what the trend is. But here's the thing, the S&P 500 represents 500 stocks, and they're all doing their own thing. Now, many of them in an environment like we've seen are all doing a very similar thing. And there's a market maxim called a rising tide lifts all boats. And what that means is if the market's in a bull market, that's when most stocks are going to be going up. When the market's in a bear market, when it's going down, most stocks are going to be struggling. And that over time absolutely is the case. If you look at the long term, look at multiple market cycles, that's pretty much what happens. But what's interesting is what breadth indicators tell you. It's how broad an advance is. And what that means is the S&P 500 is doing one thing. What are all the component stocks doing? So what you could do is go through 500 individual charts, which is one of the things I do every weekend, is go through all 500 S&P names and make some notes about what I'm seeing. And on my show today, you'll get some of the themes, some of the patterns that I noticed over my weekend review. But your goal is basic. You could go through 500 charts. That takes quite a bit of time, especially if you're not comfortable with that. That could take hours to kind of go through it. So what a breadth indicator does is it kind of simplifies it. What this is basically doing is saying every day, let me look at all 500 stocks in the S&P 500. That's the green line right here. How many of them are advancing or closing higher than yesterday? Great. How many of them are declining? And you take the difference from the advancers minus decliners, and that gives you a value. Maybe 200 more stocks on that day closed up versus closed lower. The cumulative nature of these means every day you're accumulating those values, you're adding them together, and over time, you have a trend in the advancers and decliners. And so when the market's in an uptrend, usually this advanced decline line is going to be going up because you have more up days than down days. You have more days where stocks are closing higher versus closing lower, and the trend is positive. The danger is when that stops happening and when you see lower highs in the breadth, which is what we're arguably seeing now. If that didn't answer your question, on stockcharts.com, there's a thing called Chart School. Search for breadth indicator, and it will be all sorts of articles giving you a lot more details than I just gave you on what composes breadth. Yeah, in bear cycle, I cringe a little bit when I talk about bull and bear and generalize, and I tell you the least favorite thing on the planet for me as an investor, and especially as a strategist who puts ideas out there, is when you are labeled a bull or a bear. I think when we oversimplify by labeling someone as a bull or a bear, or even worse, the dreaded perma-bull or perma-bear, I think you're oversimplifying. And again, for me, it's not about being bullish or bearish, it's about the evidence. And when the evidence is bullish, I'm going to be bullish. And when it's bearish, I'm going to want to rotate and be more bearish. And it's all about having a good toolkit to understand the bearishness or bullishness. And what that means is just overall positive or negative evidence and what it's telling you. Is the market overall in conditions that support higher prices or lower prices? And that's what I mean when we overgeneralize to the labels bull and bear. I would also, as a wrap up to my presentation, that I would encourage you not to label yourself as bullish or bearish. I think we often will get in our own mindset, and that opens up this painful bias called confirmation bias. And if you don't know what that is, go to marketmisbehavior.com and search my blog for confirmation bias. I'll show you a lot of examples of how that can creep in.